Good morning, students. Welcome to our LVC classes. And we are in the last leg. In fact, today is the last class, and it pertains to the statutory updates. Now, if you recall our previous class, in the previous class also, we discussed statutory updates. And I took you through step by step, starting firstly with statutory updates of the previous exams, then statutory updates given behind your module pages, which is pertaining to Finance Act 2025 related changes. And now we are going to deal with statutory updates post Finance Act 2025 and up to the date relevant for your exams. Now we all know, as per our institute rules, you have to be prepared for all the amendments up to 6 months before the date of your exams. So in this particular study mat statutory updates topic, we are going to deal with all those updates which are applicable to you, which are pertaining to all the earlier finance acts which have been notified till 31st of October 2025. That is the date which is relevant for your May 2026 attempt. We'll start one by one. We'll start with the GST related updates first, and then we will move on to your further updates of customs and then FTP. Now in GST, we have to be very thorough with all the updates that have come specifically relating to this particular attempt, and more so because since these are the updates specifically for your attempt, there is a very strong possibility that you may expect them in your exams for this particular May. Hence, we need to analyze these updates in detail to understand not only the updates, but what could be the implication of these updates in your exams. Now, first update is relating to the chapter of charge of GST. Now, within this chapter, if you remember, we have the charging section, section 9. Now, in section 9, there are 3 persons on whom the law imposes the responsibility to pay tax. Firstly, it is the supplier, which covers 90% of the transactions. Then it is the recipient, which covers more 7-8% of the transactions. And then you have the last category under section 9 bracket 5, where the e-commerce operator, that is the online portal, the online app through which you are providing some notified services only. See, normally we are using these online portals to mainly purchase goods. However, in this particular case, what we are going to deal with is the notified services, because 9.5 does not covers those apps like Flipkart, like Amazon, which deals with supply of goods. They are not covered in 9.5. 9.5 only covers, and parallel obviously to 9.5 is 5.5 of IGST Act. It only covers certain notified services supplied through e-commerce operator. Now, what are those notified services? They are notified by notification number 7/2017 for the central tax and notification number 14/2017 for the integrated tax, that is IGST tax. Now, what are these services which are already notified? So before I go to the amendment, we are just doing a revision also. So 9.5 covers firstly transportation of passenger service by way of radio taxi, motor cab, maxi cab, motorcycle, etc. So basically what gets covered over here, it covers your Ola, Uber, Rapido, all these apps. So these are the first services which are covered over here. Second, it covers again transportation of passengers, but now using omnibus. So we have these small tempo traveler buses where nowadays people go on different types of travel and they book it through online apps. So even tempo travelers and small buses, which are called as omnibuses, are also booked through apps. So in this case also the e-commerce operator, that is the app which is providing this omnibus, will be covered. Then covers the another service which is accommodation in hotel, in guest house, campsite, etc. So again, when you are going on travel and you also book the hotel through online apps like Make My Trip, Agoda, etc. In such cases, the apps are liable to pay tax under 9(5). But this particular service comes with a precondition. It says that where the person supplying such service, it means where the hotel is already liable for registration under 22(1). It means the hotel has already exceeded 20 lakhs limit and it is as a supplier already required to register and pay tax. In that particular case, the e-commerce operator will not be covered in 9(5) and that particular service will not be covered under 9(5). So in that particular case, the hotel itself would be liable to pay the tax. Then comes another service which we call as housekeeping. Now, in housekeeping, what is covered? Housekeeping covers our day-to-day services like you require a house help during Diwali and all these festivals. You require people for cleaning the house, windows, sofas. Then you require people for repairing your refrigerator, microwave oven, etc. Or you require plumber, driver, carpenter, all these people who are required for your day-to-day daily necessities of life. That is what is called as housekeeping. Now, you would be knowing that in urban cities, it is very difficult because people over there are regularly migrating for the purpose of their job and employment. So whenever a person, a family goes to a new place, right from booking the flat for their stay till booking a house help, booking a driver, all these things are done using online apps. So there was a very famous app which started this service, which is Urban Clap. Today it has been renamed as Urban Company. So there are similar such apps through which you book these housekeeping services. Now for such services also 9(5) is applicable with the same condition that the supplier who is supplying these services should not be liable for registration under 22(1). If the supplier is liable for registration, then the supplier has to pay tax under forward charge. The service will not be covered under 9(5), that is ECO will not be required. Then comes the services of Zomato, Swiggy, where the service which is provided using app is supply of restaurant and other services by restaurants or eating joints. So whenever you order food, now the food companies who are doing these delivery, the food delivery apps, they are required to pay the tax under 9(5). Now, all these are the services which are already covered in this particular 9(5) category. Now we come to the amendment. And with this amendment comes a lot of new issues. But let us try to understand so that when it comes in exams, you should be knowing that yes, this is what we have studied in amendment and this is what is covered in the 9(5) now onwards. Now, what is this particular service? This service is service by way of local delivery. What is local delivery? Interestingly, it is not anywhere defined in the law. But local delivery, by this, I believe, or rather, this is what is the intention also. They want to cover services like Porter, like Blinkit. So nowadays, these new apps have started off late recently, where within the local limits of the city, if you observe, these apps will not provide you intercity any type of delivery service, but within the local limits of the city, if you want to send someone, let us say, some set of documents or some small keys bunch or some small, let us say, your tiffin. So all these small things are delivered, or I will say transported, using these apps. And this is what the law covers in local delivery. Now, again, it comes with the same exception that where where the supplier of the service, that is the blanket or all these persons who are supplying services like these small transporters who are doing this transportation service, if they are liable to be registered under section 22(1), then their services are not covered in 9(5), then the supplier, that is the transporter, the local delivery person who is doing this local delivery, will himself herself be liable to pay GST under forward charge. But where their turnover is below 20 lakhs, they are not liable to register under section 22(1). In that case, the apps, that is the Blinkit app or this Porter app or similar apps through which these local delivery services are provided, that app will be required to pay GST. So students understand what is covered in this particular service. So this service covers the intra-city delivery of goods, of small articles. Like many times it happens that you forgot something while leaving for your office, and that has to be delivered to you urgently, or you want to send some set of documents to someone immediately. So these local delivery apps are nowadays used extensively and regularly. So nowadays they are available in even smaller cities. So those apps services are covered here. This is the new addition to 9(5). These services have come into effect from 22nd of September 2025. So this date is also important for your exams because it is the recent amendment. So in case you have provided any services through these apps before this date, it is not covered under 9(5). In that case, solely the supplier of the service will be liable. If the turnover of the supplier exceeds the limit, the supplier has to take registration and pay tax. However, after this date, the supplier of the services will not be liable, but with the same exception, if the supplier of the service has its own turnover exceeding 20 lakhs. In that case, the supplier of the service has to take registration and pay tax under forward charge. Otherwise, the services will remain under reverse charge. Reverse charge means under 9(5). So, Blinkit, Porter, these are the apps which are now covered in this amended entry. So kindly make a note of this. You should expect a question on this in a type of case study or in a type of MCQ where you have to select the correct option. So whether it will be supplier or recipient or the e-commerce operator, this type of MCQ based question may be asked. Now coming to another big amendment. Now if you remember, on 22nd of September 2025, or from this date, there was a big change in the tax structure of GST. So we shifted to a two-slab tax rate structure as per the uh, statements of the government, whereby now they have removed 12%, 28%. We only have 5% and 18%. Though this is not fully correct, because besides these two, you have 0%, you have 40%, but at least from the perspective of government, they have rationalized the rates and they have removed that 12% slab. They have removed the 28% slab, and many of these supplies, which were in 5%, 12% or 28%, they have either been shifted to 18 or they have shifted to 5. Now, in this regard, there is one important change relating to GTA services. Now, firstly, for GTA students, you have to remember first there are many exemptions relating to GTA. So whenever we talk about GTA, you should first check for the exemptions, that whether or not your GTA service is liable for any exemption. If it is eligible for any exemption, then anyways you are out of the taxability. There is no question of taxability. Done. Now, once you are not covered in the exemption, it means your services are now liable to tax. Then comes the second part, whether it is taxable under forward charge or reverse charge. Now, recently, in 2024, there has been an important change in this particular taxability of GT under forward and reverse. Now, what is this change? Now, the GTA is given option that every year by filling in a particular declaration, if the GTA wants, it can shift its taxability from forward to reverse or from reverse to forward. So the taxability of GTA services are shifted or optionally shifted by the GTA, and this can be done at the start of the year. Most important, whatever option you have opted will then remain compulsory throughout the year. Now, this is the first point. Now, within forward charge, if let us say the GTA has opted for forward charge, there are two rates, and these two rates are again optionally allowed to the GTA. So GTA can optionally avail these two rates. And for this, they do not have to give any declaration within forward charge. The GTA can shift between the two rates transaction wise. So maybe for one billing, they can use the one rate, and the other billing, they can use the other rate, both but under forward charge. Then if the GTA opts for reverse charge, there is one single rate under reverse charge. Now, the rate under reverse charge, where the GTA has opted that its services would not be taxed by the GTA but would be paid by the recipient, that is under reverse charge, there is only one rate which is 5%, which has no change. But where the GTA has opted for forward charge, that is, the GTA itself would be paying the tax. In this particular case, earlier the rate was 5%, one option. As I said, there are two rates, which has remained unchanged. And the other rate was 12%. Now, this 12%, as I just said, this slab itself has been removed. So this 12% is shifted to 18%. So what has changed in GTA is that where now, if the GTA opts for forward charge, in forward charge, the GTA has two rate options, which it can opt for every transaction. There is no barring. It can opt for 5% rate in one transaction and 18% rate in another transaction. Now, somebody will say, sir, why there are two rates? So the reason is where the GTA does not want input tax credit, that is, it is not having any input tax credit which it cannot avail or utilize, then the GTA can use 5%. But where, let us say, it has recently purchased trucks or it has huge amount in its input tax credit, there it can apply for 18% because 5% is without ITC, 18% is with ITC. So this is the difference between the rates. So first, important amendment relevant for your exams is where GTA is under forward charge, the GTA will be taking 5%, which has remained unchanged without ITC, or the second option is 18%. This is with ITC, and this is the amendment. Now, on similar lines of GTA, there is another service which is renting of motor vehicle service. So you can also call it as the rent a cab service. Now, under this also, on similar lines of GTA, there are two options. The two options is again, they can opt for forward charge or they can opt for reverse charge. However, in this particular case, the rate under reverse charge 5%, which has remained unchanged. Under forward charge, again, they have two options, 5%, and earlier, which was 12%, has now become 18%. So this is again very similar to the GTA, that there are two possibilities, forward charge and reverse charge. And whenever it is under forward charge, then this rent a cab service. Now, firstly, when this service will come under forward charge. So over here, you have to be very careful with the requirement of the section. The requirement of the section is taxability of service by way of renting of motor vehicle designed to carry passengers, where the cost of fuel is included in the consideration. So where I'm only giving my vehicle, the fuel is not borne by the supplier, that is by me. It will be taken care of by the recipient. Then the service will not come over here. Only when I will be giving the vehicle along with the fuel included, then only it will come under renting of motor vehicle services. Here, the two rates are, if the supplier of service is only taking limited ITC, then the rate applicable is 5%. This has remained unchanged. And where the supplier wants to avail full ITC, that is without any restriction, then earlier the rate which was 12% has been made 18%. Again, both these rate amendments of GTA and rent-a-cap have become applicable from 22nd of September 2025. So these are important rate changes. Kindly make a note. There are multiple rate changes, but they are not applicable for your exams, but these two are applicable for your exams. Now we come to the next chapter. Now this chapter deals with exemption. Now, as you all know, students, within exemption, we are not required to study exemption for goods. What is covered is only exemption for services. So you need not prepare for the exemption entries for goods. However, for services, all the exemption entries in services are applicable. We are required to cover those exemption entries. Now, in this exemption entry, there is one amendment. Now, this is a linked amendment with the previous amendment that we studied relating to local delivery apps. Now, what is this linked amendment? So, in the exemption, there is one entry relating to entry number is serial number 18, which says that service by way of transportation of goods. Now, this is the exemption. So, whenever you are transporting goods by road, it should be exempt. However, there are two exceptions given in this entry itself. That is, first is where you are transporting by GTA, it will not be exempt under this entry, or by courier, or by inland waterways. Now, what they have given in this particular entry itself by way of explanation is nothing contained in this entry shall apply to local delivery services provided by an electronic commerce operator or local delivery services provided through an electronic commerce operator. So what is this? So the exemption entry relating to transportation of goods, which covered all transportation of goods by road except GTA, courier, inland waterways, all these which were covered here, they have given an explanation saying that nothing contained in this entry shall apply to. So what it basically means is that local delivery services are not covered in this exemption. It means local delivery services will always be liable to GST. Now, interestingly, here there are two types of local delivery services mentioned. One, local delivery services provided by e-commerce operator or local delivery services provided through e-commerce operator. Now you'll say, sir, what is the difference? See, the difference is one, there are few apps which are themselves providing the local delivery services. Means what? They have their own employees who are employed with them, maybe not on the payroll, but like gig workers, but they are their own employees. And through their own employees, they are transporting or providing you local delivery services. So that is where the first point comes, that is local delivery services is provided by e-commerce operator. Second is where the local delivery is done by some individual and the individual is registered on the app so that you can book those services. That is, you can book that person and that person will be booked through the app. Here, the e-commerce operator is only acting like a mediator. The e-commerce operator itself is not providing any services, but there is some third party, some individual who is going to do the transportation of your goods within the city using the app. So that is what is local delivery services provided through an app. So as you will see, there are few apps who are having their own employees. like Blinkit. They are having their own set of employees. They are doing transportation by themselves. That is point number one. That is also not covered in exemption. Second, where like porter, where people who are ready to do delivery from one place to another, they will register themselves on this porter app. And let us say I want to send some documents to you within a range of 10, 12 kilometers within our city limits. Then in this particular case, I will go to the porter app. Over there, I will book that I want to transport. Then one of these persons who have booked themselves on the app as the transporter, they will select my particular uh, proposal, and then that person will come to do the delivery at my doorstep. So this is where the second point comes. Local delivery is provided through an electronic commerce operator, means the services are done by some independent individual who is not employed or who is not working for the e-commerce operator, but it is working in its independent individual capacity. Only for getting the work, it has registered itself on the e-commerce operator. So both categories are covered and both are not covered in this exemption entry. So what are the two categories referred over here? First, where the e-commerce operator, that is the app itself, is doing local delivery. Second, the app is not doing local delivery. Some individual is doing the local delivery, but it is using the app to get connected to get the work. Now we come to those exemption entries which are added to this particular exemption list. Now here, this was a long awaited request by many central ministers also and by people at large that these services should be given exemption. Now, from September 2025, 22nd September, this particular exemption has been granted. What does the exemption says? Services of life insurance business provided by an insurer to the insured. So we'll first study this part, then we'll go to the exception. So today, there are lakhs of people in India who are availing or taking a life insurance policy. It may be from the LIC or from Bajaj or from ICICI, from any insurer who is registered with the IRTA. So, where we are taking these insurance policies for ourselves or our family members, now from 22nd September onwards, the insurance service itself has been made exempt, which means that now onwards, whenever I will be paying insurance premium, I will be taking a policy. I'm not required to pay GST. Now, here there is an exception which says that we will be giving exemption. That is, this exemption entry will cover only services of individual or family insurance, not of a group. Now, what is this group which they have excluded? That we'll discuss. You will get to know from the explanation, but let me give you an idea. So basically, this insurance services are also used by businesses. How? Like businesses, they insure their employees by taking a group insurance policy, or they may be insuring their directors, or they may be insuring their partners using keyman insurance policies. In such cases, the exemption entry is not going to cover it. It means where the insurance is taken by the business, either for its employees or directors or partners, that is not eligible for this exemption. So what is given in the explanation? For the removal of doubts, it is hereby clarified that this exemption shall apply to a contract of insurance where the insured is an individual or an individual and family of the said individual. Further, for the purposes of A above, family shall include all individual insured as family in the contract of insurance. So by this explanation, they have clarified that when an individual is taking a policy, exemption is applicable, or where the family member of the individual is taking the policy, exemption is applicable. But if there is some business connection and your employer, your partnership firm, your company is taking that insurance for you, or maybe your family, it will not be covered. So there should be a direct linkage between the insured and the people for whom the insurance cover is taken. Now, here an important clarification is that when this point A says that individual and family of the individual, what does family includes? Because many times you'll find that there are different meanings of family. In some cases, it is only spouse and children. In some cases, it is spouse, children, parents, brothers, sisters, and so on. Here, they have clarified that here family will include all those individuals for whom we have taken that family insurance. So here they are not restricting the definition of family only to your brothers, sisters, or only to your parents. So let us say even your grandparents are covered, or let us say your brother and their children are covered. So whoever is covered in your insurance, in your family insurance, they all will be getting this exemption. But again, what is important? Where under some business relation insurance is taken, it will not be covered. Then comes 36B. Now, this again is a very big amendment, very big exemption. So many of us, especially post-COVID, have started taking health insurance, though it should have been taken even before COVID, and it should be part of your regular portfolio. That whenever you are investing, your one part of the investment or savings should go towards taking a health insurance for yourself and your family. Now, in this particular case, whenever health insurance is taken, so the health insurance premium is what is put in exemption over here. So what is covered in 36D? Service of health insurance business provided by an insurer to the insured, where again the insured is not a group. And again, what is the explanation? For removal of doubts, it is clarified that this exemption shall apply to insurance where the insured is individual or individual and family of the individual. And again, same point, for the purposes of a family will include all individuals. So what is covered over here is only personal health insurance policy, or as we call it commonly as Mediclaim, or your accident policy. All these are covered. And again, it will cover only of individual and family, where family can be any family member, not necessary your direct blood relation. But business relations will not be covered. Then another addition is reinsurance of insurances covered in the above two entries. Now, many times it is within the insurance companies that when they take a policy, they get it reinsured from another reinsurance company. This is just to minimize their risk. So when these insurances are given by the insurance company to the policy holder directly, that is exempt. Plus, where there is another insurance company who is reinsuring the insurance given by the first insurance company in these two entries, the other insurance company doing the reinsurance service is also exempt. So the main insurance and the reinsurance relating to these two cases is what is exempt. Now, amendments to certain definition. Now, in the exemption entry or in this exemption notification, after all the entries are over, there is this explanation 2, which gives exemption, which gives a definition of many of these entries. Now, in this, one definition is of GTA. Now, how was GTA defined? It was defined to mean a person who provides services in relation to transportation of goods by road and issues consignment note by whatever name called. So this was the definition of GTA. Now this definition has undergone an amendment. What it says, GTA means any person who provides services in relation to transport of goods by road and issues a consignment note by whatever name called, but does not includes. Now, what they have excluded from the definition of GTA is again the same local delivery. So GTA first part of the definition you can say is similar to the original definition, which says that GTA will mean any person who provides services in relation to transport of goods by road and gives a consignment note by whatever name called. But it will now not include those electronic commerce operator either who are giving the local delivery services themselves or where the local delivery services are given by a third person using the e-commerce operator app. So simply local delivery services, whether done by the app or done by a private individual through the app, both are now not covered in GTA. So GTA will now not be covering the services of local delivery, and GTA indirectly will cover the intercity transport. So this is how we are analyzing this. This is how we are interpreting it. That GTA will only cover the services which is intercity transport and not the services which is intracity transport, because somewhere local delivery is indirectly point in this particular entire law to mean the intracity transportation of goods, where goods have to be taken from one place to another. Next, another definitions for the purpose of entries as serial number 36 C and D, that is a life insurance and health insurance. Group means, now if you remember group, they said that the insurance should not be for a group, because if it is for a group, it is not exempt. Now what is a group? As I said, it is the business relation, indirectly what they are covering. So here they have defined group means group of person who join together with a commonality of purpose or for engaging in a common economic activity other than availing insurance. So indirectly they are talking about business relations. So what they are saying, group is group of persons who have joined together with a commonality of purpose. Now, if you remember, similar is the definition under Partnership Act of Partnership and under various acts wherever we want to say that the person have come together for earning income. Like if you remember Income Tax Act, even in there, in that act, the definition of AOP covers this similar reference that where they come together for a common purpose, where the common purpose is engaging in some common economic activity. So this is how they are referring to all the business relations. So what will be a group? A group will be that particular group where people have come together and their purpose is some common economic purpose. Now, they have further clarified that this will further include what? Employer-employee. So that is one group. Then where an employer-employee relationship exists between the master of the group, policyholder, and the members of the group. So in short, who is the master or in whose name mainly the policy is taken? It is taken in the name of the employer, let us say a company, and it covers who are the beneficiaries of the policy. It is the employees. So first is employer-employee group. Second, non-employer-employee groups. So here who are covered? Company and directors, partners and firms. So what it says, where a clearly evident relationship exists between the master, policyholder and the members for services activities other than insurance. So here they are saying it is a non-employer-employee group. So it will cover what? Director company, partnership firm and partners. So where again, under a business relation, some insurance is taken that will not be exempt or not be covered for exemption purpose. Why? Because they will fall in group, and we have seen in the entry that wherever insurance is done for a group, that is what is not covered. Shouldn't just allow me 2-3 minutes. Yes. Mm. So this is one important definition. So what will be group? Because this group is excluded from the exemption. So again, I repeat, all business relationships will be the group mentioned over here where exemption will not apply. Then comes the next definition. It is of health insurance business, which means the effecting of contracts which provide for sickness benefits, medical, surgical, or hospital expense benefits, whether inpatient, outpatient, travel cover, and personal accident cover. So, within health insurance, they have increased the scope by including all those contracts which will provide for covering what type of benefits. One is sickness benefit. So, where your insurance is to cover any type of sickness, that is health insurance. Second, for any medical, surgical, or hospital expense benefits. So, if you are admitted in hospital or if you are undergoing any surgery or you're taking any treatment, all these are also covered in health insurance. Then, what is clarified is whether these services of health insurance are taken as an admitted patient, which is inpatient, or as a non-admitted patient, that is outpatient, both are covered. Because nowadays, for many treatment, you need not get admitted, but insurance companies have started giving you benefit. Like many times for this treatment of cancer, when you have to take this chemotherapy. Nowadays, it is a day's process. You go in the morning, and instead of getting admitted for a whole day, which was earlier a requirement, that is for 24 hours, now they are providing you recliner chairs where you can sit, and on the chair itself, your entire chemotherapy is undertaken throughout the day. And then by the end of the day, once you start feeling good, they discharge you. So, such cases are nowadays covered by insurance policies where actual admission of the patient, which was earlier a condition, has been relaxed. So the exemption also is addressing that scenario. And hence, in the definition of health insurance, they are covering all the cases of medical surgical expenses, whether you are admitted, that is, you are inpatient, or you are outpatient. Then it also covers travel and personal accident cover. Now, this is interesting. So, travel cover, how can travel come in health insurance? So, see, nowadays there is a concept, students, called as medical tourism. And let me tell you, India is one of the biggest medical tourism hubs. What is medical tourism? So, in many countries, like in case of very advanced countries, Germany, Italy, etc. The problem is the costing of expenses is very high because their overall local expense is the cost of living and standard of living is very high. So expenses of any nominal treatment is also very high. Secondly, for some not so developed countries like Bangladesh, Vietnam, including Pakistan, for them, there are no proper medical facilities. Now, in both these cases, for these super developed countries or even for underdeveloped or developing countries, people are nowadays preferring India as the destination for getting some major surgery treatment done, especially which requires a long duration. So people are coming to India for a month or 3 months or 6 months for getting themselves treated, staying here, going through the entire care routine, and then returning back. Now, such cases have increased in past few years, which is a good point for India because now India is also indirectly becoming the hub for providing these medical services. Now, when this type of medical care is to be given, the packages that are given by hospitals are a lump sum package, which will cover end-to-end services. So nowadays, for these out-of-country patients, the hospitals give package which will include their entire stay cost, their travel cost, and that will be including with their family member, whoever is escorting them. So their food cost. So that is how nowadays the medical or the hospitals have designed their packages. Now, on similar lines, nowadays the health insurance policies are also addressing this point, and they are covering the premium which will be for covering all these expenses. So wherever you are getting admitted, not only for the medical treatment or the hospital expenses, but also all these other expenses like travel, stay, etc. is covered. The insurance companies are providing all these expenses also in your health insurance policy. So the exemption, taking a note of the present scenario, has expanded the definition of health insurance to even cover the travel cost. And then the last part is personal accident cover. So even for accident, nowadays many policies have benefits. Many times they are giving double benefits in case if someone passes away in accident. So that is what is all covered over here. Again, all these amendments have been done in both the notifications. One is the central tax notification, which is 16 bar 25, and the integrated tax notification, which is also 16 bar 2025, and both are dated this. So why these notifications? The amendments have been done to the parent notification, parent exemption notifications. Now coming to a very important part, valuation. Now in valuation, what is important? If you recall valuation, so we have section 15 for valuation. Now section 15 has 5 subsections. One, which says that value will be your transaction value subject to two basic conditions being fulfilled. And if you fulfill those conditions under one, that is transaction value is to be taken as your final value for the purpose of computing GST, then subsection 2 and 3 also have to be applied. Subsection 2 talks about what will be additions to the transaction value, and subsection 3 talks about what will be subtraction. Then subsection 4, which says that in case you do not satisfy the condition under subsection 1, that is transaction value is not applicable to you, then you can come to subsection 4, and subsection 4 will take you to the valuation rules. And last is subsection 5, which overrides all the above subsections. And subsection 5 says that wherever the value is determined by the government, that is, the government wants to fix a value, it will notify certain goods or services for which the value will be fixed by the government. And that will be the cases covered in 15.5, where the value will be notified by the government. So you need not take transaction value, you need not go to valuation rule, you will directly take the value notified by the government. So 15.5 deals with that. Now in this whole section 15, we are over here referring to 15.3. Now, firstly, as I said, what is 15.1, 2, 3 dealing with? All these three subsections says that where you satisfy conditions given under subsection 1 of 15, your value to be taken is transaction value. In that, additions have to be done as given in subsection 2, and subtraction has to be done as given in subsection 3. Now, subsection 3 gives only one subtraction. What can be subtracted while computing your assessable value? It is the uh, what can be subtracted? It is the discount. Now, section 15.3, which talks about subtraction, talks about discount, and there are two scenarios covered. One is in 15.3a, that is the discount given at the time of supply. So on the face of the invoice, the discount is subtracted. Now, this is the most common discount, especially nowadays in online purchases. You find that in online transactions, many times they say that the price of this is 20,000, but right now there is a 60% offer going on. Hence, after subtracting 60%, you have to only pay this much. So this 60% which is subtracted is the first category of discount covered in 15.3a, which is the discount given on the invoice, which is the discount given on or before the supply happens. This discount has to be subtracted as per 15.3a without any condition. So there are no conditions attached to 15.3a. But when we come to the second type of discount, which is covered in 15.3b, there is some stringent conditions attached. Now, what is 15.3b covering? 15.3b is covering post-supply discount. Now, what are post-supply discounts? Post-supply discounts are those discounts which are given later after the supply concludes. So let us say today you buy my goods or services. Let us say my invoice says 1,50,000. So my invoice is of 1,50,000 and the goods services are purchased today. In this particular case, when these goods services are purchased today for 1,50,000, maybe I have given some discount at the time of invoice or not, but that is not our point of discussion because even if it is given, it is subtracted as per 15.3a. Now, this 150 is the net after the discount, if any. Now, this 150 you are supposed to pay in next 3 months. Now, if you make a prepayment, that is instead of 3 months, you make the payment within 1 month. In that particular case, if you are making the payment within 1 month, then you are going to get a cash discount because instead of using the 3 months credit period, you decide to make the payment in 1 month. So I will be giving you a cash discount. In this particular case, the cash discount which I am giving you is covered in 15.3b. This is the first example of post-supply discount. Second example of post-supply discount. So one is the cash discount for making early payment. Second is many times, many businesses have the concept of turnover discount, or you can also call it as incentive. What is this turnover discount or incentives? Many times you are given a target that if during the year, and this generally happens when you are a distributor or a wholesaler retailer of some company. So in that particular case, whenever the company is asking you to do sale of its product as a distributor, as a wholesaler, in that particular case, when you are acting as the wholesaler distributor of that particular company, then you are given a target by the company. The target is what? That if during the year you achieve sales of, let us say, 1 crore, then we will give you 2% discount or 2% incentive, 2% sales commission, whatever they may call it. Now, this particular discount is not given at the time of the sale happening. So whenever you are purchasing goods from that company, the company says, okay, fine, you keep on purchasing. We will see what is your total turnover for the year. Now this, let us say by October, November, December, you cross that limit, or somewhere in January, February, you cross that limit. So the moment you cross the limit, then the company will pass on this benefit of this 2% extra discount or incentive. Many times it is done after the entire financial year is over, when all the financial year's accounting is done, adjusting all returns, etc. After that, they may give you this particular thing. So it may happen in any manner. So the point is, whenever this type of discount is given, which is also called as turnover discount or the incentive for achieving a particular target, that is also the post-supply discount. So post-supply discount may be of two types. One is cash discount for making early payment before the credit period. Second, the post-supply discount may be in the form of the discount which is related to achieving a particular target or turnover. Now, for all these types of discount, 15.3b says that we will allow you to subtract this discount. Now, how you'll subtract this discount? Please understand the sale has happened in past. So let us say the sale happened somewhere in the month of October. So October 2025, you made the sale. And now today in the month of March, I want to give you this discount either because of cash discount or either because of achieving the turnover. Now in either case, When I want to give you this discount now, the question is, I cannot go back and subtract that discount from the original sale invoice today. But 15.3b allows you this discount. So how this discount is to be given? So general mechanism is the supplier, that is the company who has supplied the goods to the distributor, to the wholesaler, will raise a credit note. Through this credit note, the discount will be passed on. Now, in this particular case, where the discount is passed on through this credit note, correct? Then comes 15.3b. Now, 15.3b says that when you're raising a credit note, what you're doing is effectively you are reducing your turnover of the current month. So whatever is two conditions, what are the two conditions? The first condition is that the discount which I have given today of a sales which already happened in October, there should be a pre-existing agreement. So if there is a pre-existing agreement, only then whatever discount I have given will be allowed to be passed on. So first condition is that we should prove that between us there was some agreement already entered by which I was entitled to this discount in future whenever either I achieve the target or I make the prepayment. Now in all these cases, wherever I am passing on this discount, the first condition which was or which is there in 15.3b is there should be a pre-agreement. Now students, let me inform you one very important thing. This condition of pre-agreement has been removed, but it is removed by the present budget, that is budget 2026, which is not applicable to your exams. But why I'm informing you? Because it should not happen that after 5-6 months, let us say after your May attempt, if for any reason you're again revisiting this section, at that time suddenly you will find this and you will say, but we were told that this is one of the conditions. So at least for your May attempt, this condition exists. There is no relaxation in this particular condition. This particular is removed by the budget 2026, but it is not applicable to you. Now, since it is not applicable to you, so at least for your exams, you have to continue with this particular condition. So first condition is there should be a pre-existing agreement. Then comes the second condition. What is the second condition? The second condition is that your recipient, so you are a company, you have given this credit note to your distributor, to your wholesaler, that recipient should have reversed its ITC proportionately. Why proportionately? Because out of total value, some value is reduced. So to that extent, to the extent the value is reduced, the recipient should have reduced its proportionate ITC. Now, in all these cases, we have to understand few things. What are these few things? Again, with respect to this proportionate ITC, how will this person reduces the ITC? So when I'm raising a credit note, I am uploading this credit note in my GSTR1. Once I upload it with that particular person's name, it will be reflecting in that particular person's 2A, 2B. But whether that person is reversing or not, it is not known to me. Now, interestingly, again, students pay attention. From October 2025, I repeat, from October 2025, this will now automatically be known to me, to the supplier. Why? Because now you have the IMS concept. Because of this IMS concept, now when I raise one or I do anything in my one, which becomes your 2A, 2B, you are given the option in IMS to accept, reject, modify. And even if you don't do anything, it is deemed accepted. Now, if you have accepted or deemed accepted that particular transaction, then in that particular case, I have satisfied the second condition. So the second condition is I am getting the benefit of this credit note, provided you, that is my recipient, has reversed the ITC. Now you have reversed the ITC. How will this be known? This will be known through the portal. But all this is happening post October, post the implementation of IMS. What about pre-implementation of IMS? So pre-implementation of IMS, since whether you have reverse or not is not known to me, for that, this particular point is there. Now, what is this point? Now, there was a circular which said that I should take a confirmation from you. So you are my recipient, you may be the distributor, the wholesaler to whom I am passing on this discount. I should take a confirmation from you. This confirmation is regarding that whether you have reversed your ITC or not. Now, how you are going to give me this confirmation? You are going to give me this confirmation by two ways. One, if the amount involved is not exceeding 5 lakhs. In that particular case, that is the GST portion is not exceeding 5 lakhs, then you will give me confirmation by your own letterhead. You will simply write on your letterhead and give it to me that this is the confirmation. Now, confirmation that you have reversed your credit. But if it is exceeding 5 lakhs, you have to get a certificate from your chartered accountant, cost accountant, specifying that you have reversed this credit. So this requirement to procure certificate is to enable the supplier or the tax officer to verify whether or not the condition of reversal is done by you. So this is the mechanism given in this particular section. So it has been clarified that the above procedure prescribed under circular number 212 dated this for providing evidence of shall not be required anymore. Now, this is the amendment. What is the amendment? Now it is said that by circular 253 dated 1st October 25, see the date. Now it is saying that it is no more required to take this certificate. Why it is no more required? Students, I've already informed you for the simple reason that it is automatically done through IMS. Now, because of IMS, I will automatically come to know as a supplier that whether you have accepted or not. How? If you have not done rejection or modification, I will not get anything back from you in my 1A. Only when you modify or reject my credit note or anything which I have uploaded, I will get intimation in my 1A, which will tell me that you have not accepted or you have done some modification. If I'm not getting anything in my 1A, it means it is deemed accepted. And now because of this facility, I need not prove you separately. Correct? So this is what is the amendment. I hope this is understood, students. Right? Just 2 minutes, please. I hope students, this is clear. So you have to also understand the logic behind the amendment. So that is what is the logic or the ideology. Correct? Now, let us proceed. The next point of amendment is value related amendment. Value of supply in case of lottery, betting, gambling, horse racing has been changed. So erstwhile, Rule 31A of CGST rule provided as under what it said, that whenever there is supply of lottery by the organizing state, then the value will be higher of the two amounts. What is these two amounts? 100 upon 128 of the face value of ticket, or 100 upon 128 of the price as notified in the official gazette by the organizing state. So we have to calculate these two values. Higher of these two values would be the value for the purpose of computing GST. Now this is the old rule. Now this is when you are selling the lottery. So there is, let us say, lottery ticket is of 1,000 rupees. So that is what is the face value of the lottery ticket, 1,000 rupees. So 1,000, you do back calculation, 100 upon 128. That is what is the logic. What is organizing state? It means the state government which conducts the lottery either in its own territory or sell its tickets in the territory of any other state. So the state which is running the lottery is what is the organizing state. Now, this section 30, rule 31A, sub rule 2 has been amended. What is the amendment? The amendment is everything else is same. So it is still the supply of lottery by the organizing state. Organizing state definition is also the same. It is the state government who is running that lottery. Now, what has then changed is in this valuation part, what we were having divided by 128, that has become divided by 140. Now, why this amendment has taken? If you remember my previous deliberation, in the previous topic of exemption. At that point, I have told you that there has been an amendment in the rate structure. What is this amendment? So the rate structure earlier was 0, 5, 12, 18, 28, and lotteries were coming under 28. Now this slab of 28 has been removed, slab of 12 has been removed, and there is a demerit rate introduced, which is 40%. They are calling it as demerit rate, which covers some specified goods and services. Now, in that particular demerit, they had already, so where 28 was the highest rate earlier, they had included lottery in that 28. Now they have covered lottery in 140. So lottery are demerit because they are not actually any value added goods, but they are only for activities like betting and gambling. So that is why it has been kept in demerit. And earlier, the rate on lottery, betting, gambling, all these activities was 28, which has now been made 40. So by default, this valuation had to be revised because now we are assuming that 40% is the tax component included in the lottery ticket value. So if this 40% is included in the lottery ticket value, we need to do back calculation by dividing the face value of the lottery ticket by 140. Correct? Now comes the third amendment relating to this. What is this? Clarification on doubts related to treatment of secondary or post-sale discounts. Now again, it deals with that 15.3b condition. Now in relation to 15.3b, there is one more challenge. What is that challenge? Now, one, if you remember the 15.3b which we discussed above, there are two conditions. And the first condition is there should be a pre-existing agreement, which, as I said, has been removed by Finance Act 26, but not applicable to your exam. So for your exam, the first condition is also applicable. The first condition is what? That there is a pre-existing agreement that you can give discount at a later stage. That is, there will be a post-sale discount. This is a precondition, or a pre-agreement is already there. Second condition is that they have said that you take their confirmation, but taking confirmation from all of these persons, and that also for every credit note that they have done, was a very tedious job. Now, because of this, because it was very tedious, That is why it was practically impossible, if I can use this word impossible, for these big companies to ensure that whatever credit note they are giving for passing on discount, the ITC on that has been reversed. Now, to overcome this problem, again there was a circular. This circular said that wherever the company wanted, instead of giving a GST credit note, they can give a financial credit note. Now, what is a financial credit note or an accounting credit note? It is a credit note where you are passing on the discount, but you are not passing on the GST. It means those credit notes are raised without the GST component. Now, this circular, again, it is an old circular. What it said that you can raise a credit note without GST. So we call it as the financial credit note or accounting credit note or a commercial credit note. Now, what was the objective behind this? The objective was simple, that these companies were facing the challenge, the problem of reversing ITC. Reversing means their recipient should have reversed the ITC, and it was a problem for these companies to ensure this, that whether or not their recipients have reversed the ITC. To overcome this, the companies the GST Council came out with this solution that let these companies issue credit note without GST component. Now, because of this, what happened? These companies are now no more required to depend upon whether or not their customers, their recipients have reversed the ITC. But at the same time, since these credit notes are raised by these companies without the GST component, the companies are also not reversing their sales GST. So their sales GST remains at the original level. So example, original sale was at 100 rupees and the GST, let us say, was 18%. So the company already paid 18% on that 100. Now out of that 100, you have given a post supply discount of 10. So the GST of this 10 should be 1.8, but this 1.8 is not passed on because the company itself has not raised a credit note of 10 and 1.8. It has only raised the credit note of 10, that is a discount portion without the GST portion. The impact of this is that where the company has raised the credit note only of the discount value, that is 10 in my example, but not covering the GST component of 1.8. In this particular case, the company is now not reducing its output liability because it has not taken the GST component. In fact, this credit note will not even be uploaded in the company's GSTR1. So this is a non-GST credit note. It is a mere accounting or a financial credit note, not impacting the GST of the company. So the company had originally shown sales of 100 with GST of 18 on the entire 100 rupees. Now, even though a discount of 10 is given, so the GST of the company should have been reduced by 1.8, but it is not done. It means the company's output GST remains at 18, even though its sales has now become net 90 rupees. How 90? Original 100 minus this discount of 10. So now it has become 90. Now, despite of the company sales becoming 90, the company has discharged the tax on 100 and it has not reversed that 18 rupees 1.8 discount portion GST. Why? Because the credit note raised by the company is a non-GST credit note. Now, all this was done so that the company does not faces the challenge that the recipient has reversed or not reversed their ITC. Now, from company side, the circular gave a good relief. So now companies are issuing these accounting credit notes. So they are passing on the discount, but they are not reducing their GST, which they had originally paid on sales. So GST remains paid on 100, but now the sales have come at 90. Now coming to the recipient side. Now this circular only talked about the company side. It did not talk about the recipient side. Now at recipient side, what is happening? At recipient side, the recipient had purchased originally the goods for 100. Originally, the GST on 100 was 18. So they took the credit of 18. Now, when this company gave the credit note of 10 rupees, here for them, the net purchase has now become of 90 because original purchase bill was of 100 minus discount 10. So their net purchase is of 90. But they continue to avail the credit of 18 rupees, which is on original 100. And somewhere logically, I believe this is correct, because where the company continues to pay tax of 18 and not reverse the GST portion on the discount. So on the end of the buyer also, that should not be a challenge. That it should be allowed to take the credit of entire 100 and not reverse that 1.8 credit, because the company has not given it that type of credit note. Now a new challenge came. So all this was settled by that circular, even though the circular did not say anything on the recipient side. That is where a new challenge came. What is this new challenge? The new challenge is that when these recipients, who are the wholesalers, retailers, distributors, when they receive this 10 credit note, since now this credit note is not going to affect their ITC because it is without GST, they started reporting this credit note as a separate line item in their P&L. Now, the reason for doing this was that generally this all credit note was given to them in the next financial year. So let us say we talk about financial year 25-26, which is ongoing. Company has given you a target of 1 crore sales. You achieve the sales anywhere in December, January, February, March. So when you achieve the sales, the company will give you that extra 2% discount. But when does all these things happen? The entire financial year 25-26 is over. Then your entire accounts are done for 25-26. How much you purchase, how much you return, defectives, everything adjusted. And then the company finds out what is the net purchase that you have done from that company, or what is the net sales the company has done to you. And if that net sales exceed 1 crore, the company gives you that 2% credit note. That is the incentive or the discount. Now, all these things happen in the second financial year. So in our example, it will be in the financial year 26-27, somewhere in July, August, October, somewhere you will receive the credit note. Now, when you're receiving this credit note, since the previous financial year is over, and now anyways this credit note is given as per that old circular without GST. So all these recipient distributors, wholesalers were treating this as a separate line item in their P&L, showing it as incentive, showing it as some type of benefit, some type of discount received, some type of incentive received, some type of sales incentive received. Now they started reporting this credit note as their income. Now here started another challenge. What was this another challenge? That now the GST authorities of these recipients, when they audited the recipient, they asked the recipient to reverse ITC of that 10 rupees credit note, one, or pay GST on that credit note of 10 as if they have made a fresh supply of rupees 10. So new challenge that came is that these recipients have been reporting that 10 rupees discount as incentive or discount or sales promotion, whatever names they use in their books of accounts. But because of this amount appearing as a separate line item in their P&L, the authorities, the GST authorities, asked them that why you did not reverse ITC of this 10, or they ask them to separately pay GST on this time. Now, because of both of these challenges, now these people came to a very different type of litigation, that these people, that is the recipient distributors, recipient wholesaler, retailers, are now facing challenges in GST, that what to do of that credit note. Now, see, this is that old circular which allowed the companies to issue financial credit notes, that is without GST credit note, and they could then pass on the discount. Now, what was the challenge? That these people were not reversing their ITC on that. So it is clarified that the recipient, now what clarification has come? The recipient will not be required to reverse the ITC related to this discount, which is given to them by the company by using the commercial credit note. So first clarification that came now is that because now these recipients were facing notices where their GST authorities asked them to reverse the ITC, asked them to reverse that particular credit, because the company has given them discount. So first clarification that came is they are not required to reverse the ITC. Why? For the same logic that since the company has not reduced their output tax, the company still continues to show 18 rupees as their output tax, even though their sales has become net 90. So on the similar lines, here in the books of the recipient, even though the purchase has become net 90, that is, they have received this credit note of 10 for the discount portion, they are not required to reverse the credit of that discount. So this is clarified first. So reason given, as there is no reduction in the original transaction value, and accordingly the corresponding tax liability will not get reduced. Now the second challenge. What is the second challenge? So first challenge was some GST authorities asked them to reverse ITC. Now that is clarified, no need to reverse. Second challenge is some GST authorities, they went a step ahead. What they said, these GST authorities said, "Ki do one thing. You have to treat this discount, this credit note, or this incentive which you have received as a new supply." So they said, since you are showing this on the credit side as a different line item, treat this as a new supply made by you to the company and pay GST at full rate of 18%. Now the question was that when these recipient distributors, wholesalers, etc., received incentives or a discount, whether that incentive or discount received by them also meant that they have made some supply to the company. Now, see, originally the company has supplied them goods or services. They were only doing their business of selling those goods services further. And in case they cross that 1 crore turnover or 1 crore transaction, they got the benefit of discount or incentive. But whether getting this benefit or discount incentive meant that they have made some supply to the original company, the answer is logically no. However, as I said, some GST authorities were taking this particular stand that you are receiving some incentive means you have made some additional supply back to the company. Now, this is again clarified by this new circular. So, what is the issue which required clarification? Whether this post-sale discount, which is given by the company to its dealer distributor, should be considered as a consideration paid by the company to the dealer distributor for some new supply made by the dealer distributor. So, whether this particular incentive received is against a new supply made by the dealer distributor to the company. This is now the challenge or the issue. Now here, for clarifying this, they made two scenarios. So this circular has given two scenarios that when we have to now decide whether this incentive received by you is against a new supply or not, we will go by two different scenarios. What are these two different scenarios? That whether there was an agreement between the company and the end customer. Means what? If your company has some direct agreement with the end customer is the one to whom you are going to sell. So you are the distributor, you are going to sell it to some person, that person is the end customer. If the company has originally contracted with the end customer and under that contract, which is between the company and the end customer, some discount is received by you, that discount will be considered as a supply. It has to be added in your sale price. Which sale price? Sale price which you are charging to the end consumer. So if the company has contracted with the end consumer, and because of that contract or agreement between the company and the end consumer, you have given this post supply discount, then whatever sales you are making to the end consumer, in that sale value, you'll add this 10 rupees as additional consideration. But if there is no agreement between the company and the end consumer, so company gave you the incentive. Why? Because you achieved the turnover, not because the company had some agreement with the end consumer. Then you need not adjust this incentive received, discount received anyway. In that case, that discount received or incentive received will not be considered as your supply. So this is I will say a very limited possibility that the manufacturer has some contract with the end consumer, and under that contract the manufacturer is giving you discount so that you can pass on the discount to the end consumer. This is a very limited scenario. However, this particular circular has tried to incorporate that scenario or that scenario as a condition. So now, whether the incentive received by you is to be considered as your consideration against some supply, that will depend upon whether there is an agreement between the manufacturer and the end consumer. If there are two independent sale transactions, one by the manufacturer company to you and the other by you to the end consumer, they are independent, there is no connection, then you will not treat this incentive or discount as any new supply. In that case, you don't have to pay any GST on the incentive portion or the discount portion received by you. So what is the essence? The essence of the matter is that in a contract of sale, the sale is completed on transfer of title in the goods to the buyer. Once this happens, the buyer becomes the owner of the goods and the seller has no vestige of the title or claim therein. The dealer take ownership of the goods purchased from the manufacturer and subsequently sells them to the end consumer, and the transaction between the manufacturer to the dealer operates on principal to principal basis. These discounts are simply given for competitive pricing to push sales and merely reduce the sale price of goods and are not linked to any independent activity rendered to the manufacturer. Therefore, it is clarified that such discount cannot be included in consideration as the monetary value of the inducement of further supply. So the first part of this clarification is where you have done extra sales effort so that your sales increases, so that your business increases. It means you have done this extra effort for yourself. You are not doing anything for the original manufacturer company. Hence, there will be no taxability on the incentive that you are giving, and that is where you will be not required to pay any tax on this discount. However, where the manufacturer has some agreement with the end customer to supply the goods at discounted price, the manufacturer may issue commercial financial credit note to the dealer, enabling such dealer to pass on the discount to the end consumer. Therefore, now in this second scenario where the your company manufacturer has a direct connect with the customer, they both have agreed that the company has to pass on some special discount to that customer, and that is passed on how the company gives you the discount and you pass on the discount to the customer. In this particular case, it is clarified that such post-sale discount which is given to you by the company is to be included in the overall consideration as it is inducement towards supply of goods by the dealer to the end customer. So in this particular case, where you have received the discount so that you can pass on the discount to the customer because that is the agreement between the customer and the original company, then the challenge will be at your end that you will now be required to treat this discount which you have received as an additional sale consideration. For what? For the services or the goods that you have supplied to the end consumer. So in that transaction, whatever price you have charged to your end customer, in that price, you will add this post-sale discount and you have to pay tax on this total amount. This is what is the scenario given. The next question considered over here is whether a post-sale discount extended by manufacturer to the dealer can be treated as consideration in lieu of activities performed to promote the sales of the goods. So basically, the question that is raised is that wherever any type of uh, post-sale discount is given, then can it be considered that you are providing any independent services to the manufacturer? So above case, the answer we have already seen is no. You are not providing any independent services to the manufacturer. You are doing that extra effort for yourself to promote your business. Now, what if the manufacturer has asked you to do some special sales promotion activities. And whatever cost you incur on the sales promotion activity, that will be reimbursed to you by the manufacturer. So let us take example. You are a dealer of mobile phones. Now, the original manufacturer of mobile phones wants you to run a special drive in your area whereby you will be conducting different types of exhibitions, you will be conducting different types of road events so that the mobile company's new product or the mobile company brand gets promoted, it becomes famous in your local area. Now, for this, the company says that whatever you will be spending on these advertisements or these sales promotion activities, these events, the cost will be reimbursed to you by the company. So, as per this understanding, you conduct those events, you conduct those extra sales promotion activities, and whatever expense comes to you, you inform to the company with the supporting document that, see, I have spent 10 lakh rupees on this activities. Now, this 10 lakhs is reimbursed to you by the company. And for that reimbursement, again, the company has given you this same credit note, which is without GST. Now, when this type of thing happens, that you have done some extra sales promotion activity in your area on behalf of the company, and that amount which you have spent for the sales promotion, that amount is returned to you, is reimbursed to you by the company by way of a credit note, then that falls in this particular scenario. What is this? So the dealer received this post-sale discount. They may engage in promotional activities to boost sale. However, these activities ultimately enhance the sale of goods that the dealer themselves own, thereby increasing their own revenue. In this context, the discount merely reduces the sale price of goods and is not linked to any independent service rendered to manufacturer. Therefore, it is clarified that post-sale discount offered by the manufacturer to the dealer shall not be treated as consideration. However, GST would be leviable in case where the dealer undertakes specific sales promotion activities like advertisement campaign, co-branding, customization, special drives, exhibitions, etc. And where such service is expressly stated in the agreement, which with a clearly defined consideration payable for such a supply. So where you are doing the sales promotion not for your own self. See, one is you may be doing sales promotion so that your business increases, you benefit. Two, you are doing this sales promotion because that is clearly stated in the agreement between you and the manufacturer, and indirectly the manufacturer has asked you to do this special sales promotion activity, and the manufacturer is going to reimburse you or pay you some amount for doing this sales promotion activity. In such cases, the dealer provides a distinct service to the supplier, that is a manufacturer company, and accordingly GST would be applicable. So see this one, circular 251 dated 12/9/25. This one, circular 251, has given four different answers or covered four different scenarios. What was the first scenario? That whenever the company has given you this post-sale discount, are you required to reverse your ITC? Because the company has not given you the credit note with GST. The company's credit note is without GST. Are you required to reverse the ITC? The answer to the first question is no, you are not required to reverse the ITC. Then comes the second question, whether then this particular incentive received by you represents a new sale done by you to the company. So here they have given two scenarios. Scenario one, is there a contract between the company and the end consumer to whom you are selling? Answer is no. This is the first scenario in this. Then whatever discount you have received or incentive you have received is not a supply done by you. You don't have to do anything. You don't have to pay any tax. But scenario two, the company had an agreement with the final customer. Under that agreement, the company wanted to give a special discount to that final customer. And for giving that special discount to the final customer, the company first gave you the credit note so that you can give that discount in the price of the final customer. If this is the scenario, then this question's answer changes. Then now, whatever discount you have received from the company, you have to add that discount in your sale price to the final consumer, and your final consumer sale price will increase by the amount of discount. So indirectly, you will now be paying tax on the discount, treating that discount as the part of consideration of your final sale price to the end customer. In that, you have to add this discount and pay GST. So within this second question, there are two scenarios covered. And then comes a third question, that where you are doing some sales promotion, whether this sales promotion is to be treated as a supply by you to the company. So here, if you are doing sales promotion by yourself, that is for increasing your sales, this amount is not going to be reimbursed to you by the company. Then that sales promotion is your own headache, nothing doing with the company. However, where you have done the sales promotion, carried out any specific promotional activities, done any special sales drive, or participated in exhibition, etc., and all this is done on instruction by the company to you. So as per company's instruction to you, you have entered into all these special promotional activities for which you have incurred some expenses which now you are going to recover from the company. And for recovering that, the company has given you a credit note for that amount. Then that amount which you are recovering from the company for such special sales promotion activities, sales promotion drives, that is liable to GST. It will be considered that you have provided a special service to the company and you will be required to pay GST. So students, this is what is the expense of this circular 251, which covers only one item. Logically, it covers only one item, but you have four answers. Why? Because they are covering the treatment of this one item under different case scenarios. What is this one item? The company has passed on post-sale discount to you, or you have received a credit note by the company, which is without GST. So what will be the treatment of this credit note received by you, which is without GST? This one issue is answered in this circular, but from four perspectives. First, are you required to reverse ITC on this credit note which is without GST? Answer is no. Here there is one answer. Then three answers is whether this credit note will be treated as a supply by you. Are you required to pay tax on that? In that, there are three scenarios covered. One, if this credit note is received by you under a special agreement between the company and customer, where company wanted to pass on the credit to the credit means the discount to the customer, you have to treat it as a sale. But which sale? Sale which you are making to the final customer, in that you will add this credit note and pay tax. But where there is no such agreement between your company and the final end customer, it is given to you just so that you have achieved a particular turnover. That is why, and it has nothing to do with the end consumer. Then it is not to be added anywhere, no tax to be paid. And third, where you are running a special drive, a special promotion scheme on behalf of company as per agreement with the company, and under that agreement, this expense that you have incurred on sales promotion will be reimbursed to you. There, whatever you are getting reimbursed, that has to be treated as your sales to the company, your supply to the company of promotional activities. That is where you are going to charge GST. So in these two scenarios, one, company has special agreement with the end customer, or you are doing promotional activities on behalf of company and recovering from the company. In both these scenarios, GST is payable on that post-supply discount value. So students, now we take a break, 15 minutes break, our scheduled break. And after break, we proceed with the other topics. Fine, students? amendments relating to input tax credit chapter. Now, what is this amendment in input tax credit chapter? So it is relating to ISD. Now, what is the point? Credit in respect of input services leviable to IGST also to be distributed by the input service distributor. Now see, as an input service distributor, you are the head office generally who is receiving invoices for some common input services which may be utilized by your one or more other units. Now, in such cases, you register your head office as ISD. Now, it has in fact become compulsory from 1st April 25 to do this. And you have to compulsorily distribute this common credit to all those units who are benefited or who are consuming these services. Now, what does this particular point says? So, Rule 39(1)(a) of CGST rules specify the procedure for distribution of input tax credit by input service distributor has been amended to include reference of IGST. The amended Rule 39(1)(a) is as under. So, for distribution of credit in respect of input services attributable to one or more distinct persons subject to levy of tax under subsection 3(4) of 9 or under subsection 3(4) of 5, and a registered person having the same PAN and the state code as an input service distributor may issue an invoice, or as the case may be, a credit or debit note as per the provisions of sub-rule 1A of Rule 54 to transfer the credit of such common input service to the input service distributor, and such credit shall be distributed by the said input service distributor in the manner as provided in sub-rule 1. Now, what is this point? So this point is basically the issue that ISD faces. Now, what is this issue? Now, ISD facility is so designed, the law provisions and the portal, that ISD cannot make payment of any tax. So ISD can only receive credit and transfer the credit. It cannot make payment of tax because the law presupposes that that ISD will not be engaged in any outward supply, and hence there is no need of any output tax payment by the ISD. However, one thing which was missed by the Act and the portal is that ISD may have to pay tax under RCM. So if ISD is receiving those input services like legal service, GTA service, director service, which are under RCM, then the ISD will have to distribute the tax credit of such inward services which are under RCM. But before that, it should be able to first pay that tax because RCM has to be paid by the recipient. Now, this particular thing was not available. In fact, today also it is not available with the ISD registration that it can make payment of any tax. Then how to deal with this scenario of RCM inward services? So for this, a new rule or sub-rule 1A was added in Rule 54, which said that the regular registration of that ISD. So one is the ISD registration. Besides that, you will have a regular registration. So the regular registration of that head office will first pay the tax under RCM. So whatever is the RCM inward services, that will be booked firstly in the regular registration of the head office. It will pay tax, and whatever tax it has paid under RCM, that will be passed on to the ISD registration so that the credit of that can be distributed. Now, earlier, the law, while drafting, had only covered this particular RCM under 9394. Now they realize there could be RCM under 5354 also, that is in case of interstate RCM supplies. So they have added that particular point over here. So now ISD will be even distributing the interstate, that is IGST input tax credit, which is paid on the RCM inward services. Next. Now, next is the chapter on e-commerce operator. What does the amendment over here deals with? So amendment in the list of notified services, the tax on which is paid by the e-commerce operator. Now this we did at the start of the chapter also. So in this, they have added the services with services by way of local delivery, where the supplier of the service is not liable for registration and the service is provided through the e-commerce operator. There, the e-commerce operator is required to pay tax under 9(5). So this is just a complementary amendment. Already the amendment is there in the charge section, so it is just a repetition of that. Now, in the returns chapter, there is a there is a notification which has exempted filing of annual return in some specified cases. What are these? So section 44(1) of the Act provides that commissioner may, on recommendation of council, by notification, exempt any class of registered person from filing annual return under this section. So this is the main provision. Now, what is exempted over here? So in exercise of our power, the commissioner, on recommendation of council, in respect of filing annual return for financial year 24-25 onwards, has exempted the registered person whose aggregate turnover in a financial year is up to 2 crore from filing annual return of that financial year. So people whose turnover is not exceeding 2 crore, they are exempted from filing the annual returns. So this is just to ease out the burden on small businesses. Now, the topic of refund. Now, students, in refund, there is a concept called as provisional refund. What is this provisional refund? So the moment you apply for the refund, so the law says within 7 days, the portal will give you a refund on provisional basis. So provisional means temporary because the officer has to still verify whether your refund application is fully correct or not. But the portal is so designed or the law is also so provided that the law says we will give you an initial refund within 7 days. And later on, the officer will check your return on the basis of any type of risk indication received by it. So this is what is the provision. So what does the provision says? Provisional refund to be granted on the basis of identification and evaluation of risk by the system. So Rule 91(2) dealing with grant of provisional return has been substituted as under. The proper officer, on the basis of identification and evaluation of risk by the system, shall make an order in the prescribed form sanctioning the amount of refund due to the said applicant on a provisional basis within a period not exceeding 7 days from the date of acknowledgement under this rule. So the moment you file the refund application and you receive an acknowledgement that your refund application is accepted, then until unless you are put in some risky category, the portal will automatically give you the refund in 7 days. The proper officer, for reasons to be recorded, may not grant provisional refund and proceed with the order under Rule 92. However, said order shall not be required to be revalidated by the proper officer. So where the proper officer feels that because of some risk parameters, provisional refund should not be granted, in that particular case, the proper officer may deny you provisional refund and then proceed with the order as provided in Rule 92. Next, second point in this similar categories, person not allowed refund on provisional basis. So section 54(6), what it says, the proper officer in case of any claim or refund on account of zero rated supply made by a registered person, what it specify that it can specify the person to whom where provisional refund may not be granted. In exercise of this power, the government, on recommendation of the council, notifies the following category of registered person who shall not be allowed refund on provisional basis. So using the power given over here, they have listed out who will not get provisional refund. First, any person who has not undergone Aadhaar authentication under Rule 10B. So first is those persons who have not done their Aadhaar authentication as a requirement under 10B, they will not be getting provisional refund. Now you can understand the reason for this. So the simple reason is that the government does not have the confirmation of their identity. And since the confirmation of their identity is not there, hence the government does not want to give them provisional refund. Let them come to the department, let them get the refund process, let the officer do detailed checking, then only they will be granted the refund. So the amendment is relating to who will not be granted the provisional refund. So first is person who has not undergone the Aadhaar authentication. Then second, they have identified certain sectors, certain products for which they do not want to do provisional refund, again for the reasons of risk and ensuring that there is no wrong refund given. So they have identified these four products: Akra nuts, pan masala, tobacco and tobacco manufacturer substitute, and certain essential oils. So for these products, even if you apply for refund, you have to undergo the regular procedure. Automatic 90% provisional refund is not allowed. Then comes the amendment relating to the recovery chapter. Now, there are monetary limits prescribed for issuance of show cause and passing order under 74A. I'm sure you all would be knowing that earlier the provisions were 73-74. However, from financial year 24 onwards, the new section 74A will come into picture, and now all the notices will be under 74A. Now, with respect to this, there is a notification giving the powers or dividing the powers between different levels of officer depending upon the tax component involved. So the superintendent of the central tax will do assessment where the tax component is not exceeding 10 lakhs for CGST, or it is 20 lakhs for IGST. So where IGST is involved, it is 20 lakhs. Where CGST is involved, it is 10 lakhs. And where both are involved, again, it is 20 lakhs. Similarly, the deputy commissioner or the assistant commissioner will do assessment where the tax component involved is about 10 lakhs up to 1 crore in case it is only CGST. In case it is only IGST, it should be exceeding 20 lakhs but up to 2 crore. And similarly, both are combined. And then the next authority is additional or joint commissioner. If the amount exceeds 1 crore, if it is only CGST, or if the amount exceeds 2 crores where it is only IGST, or it exceeds 2 crore where it is both IGST and CGST. In such cases, the adjudication powers are with additional or joint commissioner. Now, what is clarified? It is clarified that where a show cause notice is issued under 74A and it involves demand of both CGST, IGST, including cess, the proper officer shall be determined on the basis of combined amount of CNI, including cess, irrespective of individual amounts of CNI. So for this last column, there is a clarification. So in last column, as you see, for superintendent, the limit is 20 lakhs. For deputy or assistant commissioner, the limit is up to 2 crores. And for additional commissioner, the limit is about 2 crores. Now, in these cases, how to determine this limit? For example, 2 crores. So they have clarified that it will be C plus S combined irrespective of individual amount. So individually, IGST may be only 10,000 in that entire 2 crore, it is fine. Individually, CGST may be only 5,000 in that entire 2 crore, it is fine. But together, the limit should exceed 2 crore if you want to go to deputy or, joint or additional commissioner. The proper officer shall be determined based on the highest amount of tax paid in the show cause and statement across all tax period. So the proper officer will be determined on the highest amount of tax specified, where the show cause is across different tax periods. I hope you understood this. So where, let us say, 5-year show cause is issued, in that case, who will adjudicate? That will depend upon that in a particular out of 5, if in any 1 year the tax component exceeds 2 crore, the entire show cause will be handled by the joint commissioner or additional commissioner. Yes, Sachi Beda.
Sir, can you please explain this once more? ये ऊपर जो combined amount of CGST and IGST, because इसमें थोड़ा सा confusion है, ada confusion.
See, Sachi, for
Connectivity
this,
issue हो गया था तो समझ में नहीं आया.
see it, I'll repeat. So, who will do the adjudication assessment for this? Limits are given. So now we are on the third column where the limit is for CGST and IGST combined. Now here superintendent will do if the combined amount is up to 20 lakhs. Deputy or assistant commissioner will do if the combined amount is up to 2 crore, and joint or additional commissioner will do if the combined amount is above 2 crores. Now here what is clarified that when you are looking at these limits, so let us say I am talking about 2 crore limit. So they are saying the combined amount should exceed 2 crore, then the adjudication will be done by additional or joint commissioner. In this particular case, how to check this 2 crore? So they are saying you add C and I both, and importantly, within CNI, how much is independently CNI is not important. So within that entire amount, which is exceeding 2 crore, the IGST component may be only 10,000, and remaining entire component in CGST still 2 crore limit. If it is crossing, additional and joint commissioner will do it. So what is clarified here is that you will not see individually how much each of these taxes. So far as the total tax exceeds 2 crore, the assessment will be done by additional or joint commissioner. Similarly, the second point given, this point is, let us say you are issued a 5-year show cause notice because you are having same transactions every year. So they have given you one show cause notice covering 5 tax period. Now in this, definitely in every tax period, the amount is different. So how you will determine whether which authority is covered? So you have to see out of these 5 years, in which year highest tax liability is there. And according to that year's tax liability, which is the highest out of those 5 years, you will determine the authority. Now, in those 5 years, if in any one year the tax liability exceeds 2 crore, you will go to additional or joint commissioner. That is what is the point. The proper officer shall be determined based solely on the amount of tax demanded, excluding penalties. So while deciding the authority, you will not include interest penalties. You will only see the basic tax portion. Is this clear, Beda?
Thank you.
Yeah. Now, similar monetary limits are now also provided when orders have to be passed under section 122. Now, what is important about 122 is, see, 122 section is exclusively for levying penalty. So, section 122, which is exclusively for levying penalty, this section is again giving the same monetary limits. But now the monetary limits is not for the tax portion. The monetary limits is for the penalty portion. Again, what is clarified? It is clarified that where show cause notice is issued under 122, it involves demand of penalty in relation to both C plus I. The proper officer shall be determined on the basis of the combined, that is a total amount of penalty of both C and I, irrespective of how much is penalty in the individual category. So individually, how much is C or I will not be seen. You will see the total of both and then determine who will be your proper officer. Then coming to appeals and revision. Now for appeals and revision, what are the rules? So following changes have been made in the rules relating to appeals to tribunal. So single member, appeal where the tax or ITC involved or the amount of fine penalty determined in any order appeal against does not exceed rupees 50 lakhs and which does not involve any question of law, then with the approval of the president and subject to other conditions, recommendations, a single member shall hear your appeal. So where, now this is about tribunal, which is now yet to start, but very soon we will see tribunal also in function. So where the appeal has to be filed to tribunal, then if the amount involved is not exceeding 50 lakhs and the issue does not involve question of law, then it can be decided by a single member bench. Now for the purpose of reckoning this 50 lakhs, the cumulative tax ITC involved or the fine fee penalty involved shall be determined with reference to all issues and all tax period covered in that order appeal against. So what is clarified is that here while determining this 50 lakhs, if there are multiple issues for which multiple liabilities are being raised, you add up the liability in all the issues and then determine this limit of 50 lakhs. Similarly, if multiple tax periods are covered, You add up the liability of all the tax periods and then determine this limit. So this is what is clarified. Then what is the clarification with respect to rules 110 and 11? Again, with relation to filing of appeals to tribunal. So appeal by aggrieved person. So what does it say? An appeal to the tribunal shall be filed in form APL 05 along with relevant documents. Electronical provisional acknowledgement in Part A of Form GST APL 02A shall be issued to the appellant immediately. So the moment you file your appeal in APL 05, which will be done electronically, a provisional acknowledgement will be given in Form APL 02A. Now, what has been deleted, which was earlier here? The appeal to tribunal may be filed manually in APL 05 along with relevant documents only if the registrar allows the same. This has been deleted. It means now it is only one option available, that is electronic, to file the appeal. Similarly, where the department is filing the appeal, the application to the tribunal shall be filed in form APL 07. So when you are filing appeal, it is APL 05. When department is filing appeal, it is APL 07. And we are talking about which appeal? We are talking about GSTAT appeal. In this case, again, you will receive a provisional acknowledgement in Part A of Form GSTR APL 2A. Again, what has been deleted from here is that earlier the law provided or allowed for manual filing of appeal. Now they have deleted it, which means that only and only electronic appeals are allowed. Manual appeals are not allowed. Common provisions in case of appeal by the taxpayer or the department. Memorandum of cross objection. So after one person file appeal, the other person will be filing memorandum of cross objection. So it shall be filed in APL 06. Now in this particular case, this APL 06 again has to be filed electronically. Again, what has been deleted? The memorandum of cross objection, which could be filed manually, has now been deleted. So in short, the simple amendment in this chapter is whatever application, cross objection, whatever has to be filed electronically only. There is no scope for filing it manually. Now, what will be considered as the date of appeal? Why this is important? To count the time limit. Where the order appeal against is uploaded on the common portal, a final acknowledgement indicating appeal number shall be issued in Part B of APL 02A after removal of defects, and the date of issue of this provisional acknowledgement shall be considered as the date of filing appeal. So when you had file appeal, if you remember, you receive provisional acknowledgement in Part A, and after your appeal is accepted, after all defects are removed and your appeal is accepted, you get final acknowledgement in Part B of APL 02A. So provisional acknowledgement was in Part A and final acknowledgement is in Part B. Now, once you receive this final acknowledgement, it is a proof that your appeal is filed, it is accepted. But what will be considered as the date of filing appeal? It is the date of the provisional acknowledgement. So whatever was the date of provisional acknowledgement, that is treated as the date of filing of appeal. If the order appeal against is not uploaded on the common portal. Now let us say the order which is received is manual. It is not there in the portal. Then the appellant shall submit or upload a certified copy of the order within 7 days from the date of filing of APL 05 or APL 07, and the final acknowledgement indicating appeal number shall be issued again in Part B of APL 02A after removal of doubts, if any. And again, in that case, the date on which you got the provisional acknowledgement will be considered as filing appeal. So where your order against which you want to file appeal is manual, for that manual order also, you have to firstly point is file appeal electronically, and after filing appeal within 7 days, you have to upload or submit the self-certified copy of the order. Next, where the said self-certified copy of the order is submitted, uploaded after a period of 7 days. So you are given 7 days to upload this order, but if you do this after 7 days, now the answer changes. Now, what will be considered as the date of filing of appeal? So firstly, the final acknowledgement indicating appeal number will be given to in Part B. Again, it will be done after removal of doubts. And the date of submission or uploading of this self-certified copy will be considered as the date of filing appeal. So till now, in all cases, the date of filing appeal was a provisional acknowledgement. But if you upload the order after 7 days, then the date of acknowledgement will be the uploading of this order. So it will be the current date, and in that particular case, it may happen that if your time limit to file appeal has ended, your appeal may be considered time bar. Rule 113 of this rule dealing with order of the tribunal has been amended. What is deleted? The jurisdictional officer shall issue a statement in APL 04 clearly indicating the final amount of demand confirmed by the tribunal. Now what is amended? The tribunal shall, along with its order under subsection 1 of section 113, issue or cause to be issued a summary of the order in APL 04A clearly indicating the final amount of demand confirmed by the tribunal. So firstly, the tribunal has to send its order as per the requirement of subsection 1 of 113. So first is the order, main order, and along with this, a summary order will be given in APL 04A. So the summary order is in 04A, which will give you the amount of tax demanded. So students, with this, we have completed the GST portion of the amendment. Now we'll go to the customs and FTP portion. Anybody has any queries on this? Sachi, you have
No,
doubts in
sir.
any of the pointers, beta? Sorry?
No, sir. I had clear. Now the doubts are clear.
Super.
So we'll be doing this one now.
What?
So see, yeah, customs amendments we'll be completing right
Now
now.
we are doing customs. Yes, beta.
Sure. Thank you.
So first amendment is in the customs regulations. Regulations for what? For finalization of provisional assessment. Now see, what is provisional assessment? So under customs, you have self-assessment concept under section 17. However, section 18 of the Customs Act says that where self-assessment is not possible. Why? Because as an importer, you have doubt about the value, you have doubt about the rate, you have doubt about whether a particular exemption is applicable to you or not, you have doubt about classification. In such cases, you do not want to be wrong. So what you do is you go to the department, that is the customs, and you request them that they make your assessment. So since you are not able to do it because you are not sure about one of these things, you will request the department to do this assessment. Now, it may happen that looking at the facts and details of your case, the department is also not very sure or confident as to what is the right value, rate, classification, etc. But since you want to clear the goods and that can be done only after assessment, Section 18 gives power to the customs authority to make your assessment on provisional basis. So temporarily, they will determine a value, a rate, and they will allow you to pay customs duty at that value rate and clear your goods. But you have to come back with further details so that they can finalize your assessment. This is what is the provisional assessment finalization. Now, in relation to this, the substituted rules, there are some changes in the rules. What are they? Time limit and manner of submission of documents or information for the purpose of finalization. Now, see why we had to do provisional, because there was a doubt about value, rate, something. How it could be determined what is the correct rate, wall value. So for this, as an importer, you are required to give more details in the form of some documents, in the form of some test reports, etc. Now, how you have to submit these documents and information, plus what is the time limit that is given. So where duty leviable on import-export goods is assessed provisionally, that is under section 18, by the proper officer for the reason that necessary information document is not produced or furnished by the importer at the time of provisional assessment, then proper officer must within 15 days from the date of such assessment inform the importer exporter in writing the specific details which is required. So once you have done provisional assessment, now to do final assessment, some time limits have been included. Within 15 days, you will inform the importer what details you want. Importer exporter must make available these information details within 2 months from the date of above request. So you have 15 days, the custom officer within 15 days will send its requirement list, and after receiving the requirement list within 2 months, the importer or exporter is required to provide the necessary details. This is the point. Then comes extension. Extension in both the cases, extension allowed for submission of documents. The proper officer may, for reasons to be recorded, allow a further period of 2 months on his own or at the request of the importer. So, in this particular case, one second. So in this particular case, as we saw above, you should provide the details within 2 months. Now this 2 months can be extended by further 2 months. Next point over here is an officer to whom the proper officer is subordinate may allow additional period as deemed fit for reason to be recorded on request of the importer or exporter, but no extension under this regulation may be allowed beyond 14 months. So first you have 2 months, then up to 2 months the proper officer can allow, but the superior officer to this proper officer may allow you further extension, and the total extension that may be allowed cannot exceed 14 months. Where document informations are not available within the time allowed as per the above provision, the proper officer shall proceed to finalize the assessment based on whatever data it has. Correct? So that is logical. Then time limit to conclude inquiry for the purpose of finalization of provisional assessment. So where duty leviable on import export goods is assessed provisionally by the proper officer for reason that the officer deems it necessary to make further inquiry, the officer shall complete the inquiry and transfer the relevant documents along with the reports in writing to the proper officer for finalization of assessment, and the time limit given for this is 14 days. So in short, provisional assessment should be made final, that is final complete assessment should be done within a period of 14 months from the date of provisional assessment. During such inquiry, if any document information is required, the proper officer may seek, for which we saw the point above. Then, payment of duty of own ascertainment before finalization of provisional assessment. Now, provisional assessment will be finalized by the officer, but the importer, if he or she himself herself has now been able to determine the correct value and rate, they can make the payment on the basis of their own ascertainment. So it is not necessary that you'll only wait for the officer to do the final assessment. You may on your own pay the amount. So whatever amount you have paid shall be adjusted against the final duty assessed. However, importer exporter is also liable to pay interest on the amount so paid voluntarily. So the basic idea is, since in future, whenever the assessment is final, you have to pay interest. If you want to protect yourself from that interest, you can do your own assessment again and pay the amount. And then only on the difference, you'll have to pay the full interest on whatever amount you have paid up till now. For that amount, you have to pay the reduced interest. Reduce means till the date you have paid this amount. Now, time limit for finalization of provisional assessment. The proper officer may finalize the duty provisionally assessed where it is possible within 3 months from the receipt of documents, information, importer, exporter, or the expiry of time of submission in accordance with Regulation 4. So we saw above, you have to submit it within 2 months, which can be further extended by 2 months by the proper officer and more period by the superior officer. So after you have submitted, after that within 3 months, he should do the final assessment or conclusion of inquiry in accordance with Regulation 5 or after the inquiry is completed. Again, this period can be further extended by 2 months for reasons to be recorded in writing. However, the assessment shall be finalized within 2 years from the date of provisional assessment. So the upper time limit kept for final assessment is now 2 years. If the proper officer is unable to finally assess duty within the specified time, then what will happen? What could be the reasons for this? Information is being sought from an authority who is outside India and it is taking time. An appeal in a similar matter of the same person is pending before High Court, Supreme Court. So as an officer, you cannot proceed. An interim order for stay has been issued by Appellate Tribunal or High Court, Supreme Court. So stay is put on your assessment. Board has in a similar matter issued specific direction or order to keep such matters pending. So CBIC has asked you to keep the matter pending, or the importer exporter has a pending application before settlement commission. So these are the reasons why you are not able to complete the final assessment within the time provided. Then the proper officer shall inform the importer exporter concerned the reason for not finalizing the provisional assessment in the 2 years time limit which is provided, and shall apply not from the date of provisional assessment but from the date where such reason ceases to exist. So in this case, the time limit of 2 years which was supposed to be counted from the date of provisional assessment will now be shifted, and this 2 years will now be counted not from the date of provisional assessment but from the date where any of the above situation no more exist, because the above situations were stopping you from doing the assessment. So the moment the above situations are removed, within that, from that date, within 2 years, the final assessment has to be done. Now, what is the manner of finalization? The manner is the provisional assessment shall be finalized as provided under Section 18. Where the final assessment is contrary to provisional assessment, the proper officer will pass a speaking order, and it has to follow principle of natural justice. Where the final assessment confirms the provisional assessment, the officer shall finalize the same after ascertaining the acceptance of such finalization from the importer exporter. And where the importer exporter is required now to pay the difference amount, finally assess or reassess as the case may be, after adjustment of the amount already paid, the bill of entry or shipping bill may be returned for payment of the amount. So the manner of making payment is this. However, importer exporter is also liable to pay interest on the above amount so paid. Manner of closure subsequent to finalization. So after the finalization is done, where the final assessment has been confirmed, so your final assessment is same like provisional assessment, or duty along with interest has been paid in full in case of home consumption or exportation where the bill of entry or shipping bill has been written for payment, or the importer has executed appropriate bond binding himself for the excess duty. In all these cases, the bond executed at the time of provisional assessment with security penny shall be cancelled or recreated as the case may be, and security shall also be furnished if there are no pending dues. So how to close the provisional assessment? So you will return the bond. That you will do only after the payment has been done by the importer or the importer gives the appropriate bond. Then where duty, interest, fine, penalty or any other sum due has not been paid for more than 90 days, which is due to be paid after finalization, and the sum due has attained finality for recovery, then the sum due which remains unpaid shall be adjusted from the security if any. So despite of the time limit being given to you if you are not making payment, and now the time limit is getting over, now the officer has power to utilize or encash your security which you had given at the time of provisional assessment. Now, where the importer exporter is entitled to refund, after finalization of provisional assessment, the refund shall be processed. So this has to be done automatic. This should not require another application by the importer. Extension of time limit. Notwithstanding the time limit provided in other regulation, the Commissioner of Customs may, on sufficient cause being shown and for reasons to be recorded, extend the period of 2 years for the finalization of provisional assessment by an additional 1 year. So we studied above, you should complete the assessment, the final assessment within 2 years of provisional assessment, but this 2 years time can be extended by further 1 year. And then penalty, importer, exporter or his authorized representative or the custom broker who contravenes any of the provisions or fails to comply with the provisions shall be liable to a penalty extended to the amount which is provided in 158. So these are the provisions relating to finalization of assessment. Acha, students, here I have one important point. Yes, ma'am, I'll give you 5 minutes. So, okay, ma'am is there. So, ma'am will be covering that important point, which is relating to amendment in the baggage rules. But now, since ma'am is here, I'll complete this whole statutory update, and ma'am will give you the update for that amendment in baggage rules. So, let me then complete this. Now, next point is relating to the scheme for remission of duty. So, this is what is called as the road tap scheme. So what is this road tax scheme? So under the Foreign Trade Policy 2023, the road tax scheme was made applicable. So what is this road tax scheme? So the road tax scheme is whatever duties and taxes you have paid locally, which is not covered in your duty drawback or any such similar provision. For those taxes, you had this road tax scheme, and under the road tax scheme, you could get those taxes refunded. Now, what is the amendment? So the road tax scheme was made available for eligible exports from the domestic tariff area from 1/10/23 to 30th June 24. The scheme's effective date has been extended several times through several notification. Further, advance authorization, EOU, SEZ were not eligible for the scheme. Subsequently, the scheme was extended to include these persons from 11/3/24 to 5/2/25, and then again from 1/6/25 onwards. Now, what is the notification now? It has extended the applicability of this scheme, that is a road tax scheme, for eligible exports from DTA and by advance authorization holders, EOU, SEZ, up to 31st March 26. So all the above applicability of this scheme to various stakeholders is now finally made applicable up to 31st March 26, which is now going to close. Now, maybe before its closure, if this scheme is further extended, that will come as an update for the next exam. But as of this date for your exam, the update is that this road tap scheme has been extended for all the stakeholders, whether exports are from DTA or they are by advance authorization holders or by EOUs or by SEZs. For all of them, this particular scheme benefit is extended up to this 31st March, that is 31st March 2026. So students, with this, we have extensively covered all the amendments and whatever is part of your May 2026 exams. So in these two lectures, in a proper sequence, right? First, the old statutory updates we did, then the updates given behind each chapter of the module, which is by Finance Act 25 and that have been notified. And then finally, by the latest statutory update applicable for May, we have comprehensively covered all our statutory updates. Now, for an important amendment relating to baggage, I will request ma'am to take up the further part of the update session. Over to you, ma'am.
Sir, just 1 minute.
Sure. The student, just hold on for a minute. In the meantime, if you have any questions, any doubts, you can let me know.
Sir, we will be getting normal questions in which amendment will be incorporated, or we will be required to write also in the amendments.
नहीं, you are saying questions.
हाँ, मतलब क्वेश्चन सिर्फ अमेंडमेंट से रिलेटेड आएंगे, मींस क्वेश्चंस तो नॉर्मल क्वेश्चंस आएंगे, उसमें आपको अमेंडमेंट कोड करनी है या अमेंडमेंट
Yes,
अलग से
yes.
भी?
नहीं, सी जो हमने स्टार्टिंग में जीएसटी के अमेंडमेंट्स देखे, if you remember, over there I had explained you how you will get the questions. So see, questions will be mainly like case studies. It will not be a direct question ki, what is this amendment? Normally such questions are not asked at the final level. So it will be a case study. In that case study, you will have to
You will
mention,
have to code that.
yes, ki now as per this amendment, this will be the answer. Fine, beta?
Yes, sir, yours. Thank you.
Okay. Good morning, ma'am.
Good morning, sir, and thank you for taking all the provisions of GST as well as customs in a comprehensive manner. I hope all the revision of students now has been completed and they
Yes.
will be able to prepare for the exams. So today, actually, as you have already given a hint to the students that an important concept we want to discuss, an amendment in baggage rules, which we want to discuss with the
Ma'am, I
students.
think you will share your screen so that it will be visible.
My notepad would be visible, I hope.
Yeah,
Is
but
it
it is very
visible?
small. So
Oh,
if you can share. But now it is okay. I've removed my screen share.
okay.
Yes.
I will keep the font. I will write a bit.
Yes. So that will help to understand better. Yes. Now this is okay, ma'am.
Okay. Thank you, sir, for confirming. Students, as you all must be having the September 2025 edition of the study material, which is relevant for May 2026 examinations. So there the rate of baggage duty, concessional rate of baggage duty. As you know that on baggage duty there is a concessional rate and there is a standard rate. So concessional rate is applicable on the goods on which the duty free allowance, general free allowance is allowed. So whatever, how you compute the baggage duty, you take the personal effects, travel souvenirs, then whatever goods the person has brought from outside India, and from that we deduct the general free allowance which is applicable in that particular case, and on the remaining amount we compute the baggage duty. The rate which is mentioned in the study material is 38.5%, which is inclusive of social welfare surcharge. Now this rate has been revised and it has been changed, amended to 35% because social welfare surcharge on baggage has been exempted. So for May 2026 examination, please pay attention everybody that the rate applicable, rate of baggage duty applicable will be 35%. Effective rate of duty for baggage will be 35% and social welfare surcharge will be exempted. So you have to compute duty on baggage at the rate of 35% plus the standard rate of baggage duty which was 100% earlier. So goods which are not eligible for general free allowance, for example the firearms, cartridges of firearms, then wine more than 2 liters, and the cigars more than 100 sticks, sorry 25, cigar more than 25, cigarettes more than 100 sticks, or tobacco more than 125 grams. So this list has been given in the study material also. There will be a corrigendum which will be hosted on the website, as well as we'll be updating the chapter, the questions of the chapter also to that effect. So all of you are advised to refer to the revised chapter which will be web hosted, as well as the corrigendum which will be hosted, because this amendment has to be taken into consideration for May 2026 examination. So earlier this rate was 100%. Now for these goods the rate will be 70%. Rate will be 70%. Okay. Just a minute. New page कैसे है? So this was one thing. Second was, now one thing which I would like to tell you is that heading 9803 is the heading under which the baggage articles are mentioned in the customs tariff. So this heading is of customs tariff 9803. Okay. Here the rate which is mentioned is now 70%. As I told you that whatever goods which are not eligible for concessional rate of duty, they are primarily annexure 1 items which are there in the study material also. To name them, they are firearms, cartridges of firearms, then wine more than 2 liters, and the cigars more than 25, cigarettes more than 100 sticks, and tobacco more than 125 grams of tobacco. Alcoholic beverages are outside that. So now this is applicable for 70% rate, but in this entry also there is an exception. This exception is that this baggage will not apply to alcoholic beverages, motor vehicles, and tobacco and tobacco products. So in effect, what is the situation now? You know that wine up to 2 liters, it is allowed in general free allowance also, up to 2 liters. Similarly, cigars 25 up to 25 unit, cigarettes up to 100 sticks, and tobacco 125 grams. So up to this amount they are included in general free allowance. That means when you are computing the baggage duty and you see any of these items up to this quantity, up to this unit, you will take it in general free allowance, and you will compute as that amount you will on that quantity you will compute the duty as 35%. But if any of these goods are imported in a quantity more than that, suppose to more than 2 liters, wine or alcoholic beverages are being imported, or cigar more than 25 is being imported, similarly cigarettes and tobacco more than the prescribed units, if they are being imported, then they will be subject to their respective rates which are mentioned in the customs tariff. So for those goods, either the rate in the question will be given to you, or you will not be supposed to compute the duty. You only have to compute the baggage duty on these products. So what you have to do is you have to take only up to this quantity you can take in general free allowance, and you will be computing duty at the rate of 35%. On firearms and cartridges of firearms, if duty has to be computed, that will be taken at the rate of 70%. There are questions in the study material which will be updated. Moreover, in mock test paper also, we will be taking the questions. We will be including some questions to give you an idea that how the duty has to be computed, to give you a more better idea that how duty will now be computed. But the rate has been changed from 38.5% to 35%. And the standard rate, which was 100% earlier, for those goods which do not fall in the concessional rate, for them now rate has been reduced to 70%. These goods, as I told you, the alcoholic beverages, motor vehicles and tobacco products, they do not fall in heading 9803, that is the baggage heading. That is why on these goods in general free allowance, to the extent they are allowed in general free allowance, 2 liters of wine and cigars 25, cigarettes 100 sticks, tobacco 125 grams. They will be included in general free allowance as we used to do earlier. If more than that they are being imported, then the excess quantity will be subject to the rate which is specified for them in the customs tariff separately. But that you have to compute only when the question explicitly specifies that rate. Otherwise, you do not have to compute that duty, because you know that in GST as well as in customs, students are not expected to be aware, or they are not expected to memorize the rates applicable to the respective goods or services. In GST, no GST rates for goods and services you are expected to memorize. Same way in customs also, on all goods you are not expected to memorize any rates. That will be that are always provided in the question. Same way it will be provided in the question itself. But baggage duty rate you have to memorize. That is 35% from now onwards. So I hope this clarifies the concept. Moreover, please refer the updated chapter. Once again, I am stressing upon that please refer the updated chapter which will be web hosted by this week, so that you can prepare accordingly for the forthcoming examination. If anybody has any doubt, please ask.
No, ma'am, no doubts.
Okay, thank you. So with this, we come to an end of this session. Thank you so much.
Thank you, ma'am. Thanks a lot.
Thank you,
Thank
sir.
you. Thank you. Thank you, ma'am. Good day.
Good day.
Thank you, sir. Thank you, ma'am.
Thank you, madam.
Yes. Thank